Welcome to your personal financial war room.
Glad to be here.
If you're listening to this, you probably already know that building a long-term portfolio isn't about chasing like the latest meme stock
Definitely not.
or just throwing darts at a sector mat. It's about quantitative strategy.
Right. It's about the math.
Exactly. So today we're stepping into the role of financial analysts to run a really massive head-to-head comparison of four absolute heavyweight dividend ETFs.
The big ones.
Yeah, the big ones. We're putting DGRO, FDVV, SCHD, and VIG under the microscope. Our mission here is to help you, the listener, determine the absolute best fund for your specific 10-year investment horizon.
And looking at the landscape right now in 2026, it's a really critical mission. We aren't just skimming fact sheets today.
Well, we have the data.
We've compiled a massive stack of current data. We've got the latest ETF prospectuses, Morningstar performance reviews, historical drawdowns.
The works.
Yeah, and some really fascinating 20-year Monte Carlo simulation data.
Sourced directly from retail quant communities, right? The guys actually running the hard math.
Exactly. The community's doing the heavy lifting.
Okay, let's unpack this. We know the rules of the game have changed over the last few years, so let's just start by looking at the actual scoreboard.
Let's do it.
How have these funds performed over the last 5 years leading up to today?
Well, we'll start with the 5-year annualized total returns. So that's price appreciation plus reinvested dividends.
Got it.
The surprise leader of the pack over this recent stretch is actually FDVV.
Really?
Yeah. Boasting an 18.17% annualized return.
Wow.
Which is, it's a massive number for any fund, let alone a dividend-focused one.
Yeah, no kidding.
And it's largely being driven by its incredibly heavy tech exposure.
Wait, hold on. 18% annualized is incredible. If FDVV is crushing it at 18%, why am I even looking at the other three?
Right. Why not just buy that one?
Shouldn't we just pack up and go all in on FDVV?
On paper, it's super tempting, but let's look at the rest of the field first.
Okay, fair enough.
Coming in second and third, practically neck and neck, we have DGRO at 11.35% annualized.
Okay.
And VIG right behind it at 11.25%.
Super close.
Very close. And then bringing up the rear, we have SCHD, which has really lagged recently at around 9.08% annualized.
That's a noticeable drop-off.
It is. To put that in stark contrast, over a 5-year period, SCHD generated about a 54% total return.
Right.
Compared to VIG's 70.6%.
Which again brings me back to my question. If FDVV is running laps around SCHD, why shouldn't an income investor just buy FDVV and be done with it?
What's fascinating here is what happened to FDVV's actual payouts.
Oh, the dividends themselves.
Exactly. Despite that killer total return, FDVV's distributions actually dropped by 7% in 2024.
Ouch. 7% drop.
Yeah, it has seriously struggled to consistently grow its dividend.
Yeah.
So while the share price shot up thanks to the broader tech rally,
the actual cash it deposited into investors' accounts went backward.
Precisely.
But if my account balance is still going up, why should I care if the dividend dropped a bit? I could just sell shares if I need the cash.
You could, but that introduces a sequence of returns risk.
The dreaded sequence of returns risk.
Right, which is exactly what dividend investors are usually trying to avoid.
Because if you have to sell during a crash,
you're doomed. If you're a pure income seeker relying on that cash flow to pay your bills, an inconsistent dividend forces you to sell shares.
Yeah.
And if that dividend cut happens to coincide with a broader market downturn, which it often does, you are forced to cannibalize your portfolio.
Selling shares at a depressed price just to buy groceries.
Exactly. That's a major red flag for a pure income strategy.
That makes a lot of sense. You're trying to build a machine that spits out cash without you having to dismantle the machine itself. And this perfectly highlights why we have to look under the hood. The performance differences we're seeing and the dividend cuts, they aren't random.
Not at all.
They're the direct result of the underlying strategy and the sector DNA of each fund.
Precisely. Every ETF operates like an algorithm. It follows a strict set of filters.
Oh, let's break those down.
Those rules dictate exactly what they buy and what they ignore. Let's start with VIG.
All right, what's VIG's rulebook look like?
Its initial hurdle is that a company must have a 10-year history of increasing its dividend payments.
Which wipes out a lot of flashy, newer companies immediately. 10 straight years of hikes is a decent hurdle.
It is, but VIG's secret sauce is actually what it excludes.
What does it exclude?
It purposefully chops off the top 25% highest yielding stocks from its eligible universe.
Wait, it actively avoids the biggest payers?
Yes. It does that to dodge yield traps. You know, those companies whose yields look massive only because their stock prices are collapsing?
Ah, right. The denominator is just shrinking.
Exactly. Because of those rules, VIG ends up with a massive 28% exposure to technology
Okay.
and 22% to financials. Its top holdings are giants like Broadcom, Microsoft, and Apple.
So VIG is essentially a high-quality growth fund that happens to pay a small dividend. It's playing defense by avoiding high yields entirely.
That's spot on.
Now contrast that with SCHD.
Right. SCHD tracks the Dow Jones U.S. Dividend 100.
And like VIG, it demands that 10-year dividend growth history.
Right. It does. But then it acts like a bouncer at a very exclusive club.
I love that analogy.
It doesn't just look at the dividend history. It looks at the balance sheet. It rigorously screens for cash flow to debt and return on equity.
Right, and that bouncer completely changes the vibe of the club inside. Because of those strict cash flow and valuation requirements, SCHD strips out almost all of the expensive technology sector.
Yeah, and only holds about 8.8% tech right now.
Which is nothing compared to VIG.
Exactly. What you're left with is a highly defensive core. Nearly 19.9% in energy, 18.5% in consumer staples, and a heavy dose of healthcare.
Which completely explains the 9% total return we talked about earlier.
Right.
If you held SCHD over the last few years, you largely missed out on the massive AI and tech boom.
You did.
But you slept really well knowing you owned highly profitable cash-generating businesses.
Exactly. Now let's look at DGRO. DGRO takes a different approach to quality.
How so?
It only requires 5 years of uninterrupted dividend growth, which is half of what VIG and SCHD demand.
That sounds a bit loose. Why cut the history requirement in half? Doesn't that invite a lot of unproven companies into the mix?
It would, except DGRO pairs that shorter history with a brilliant safety valve.
Okay.
It mandates that a company's payout ratio must remain below 75%.
Ah, payout ratio.
Yeah. That means the company's paying out less than 3/4 of its earnings as dividends.
Leaving at least a 25% buffer for reinvestment.
Or to weather an economic storm without cutting the payout. It also excludes the top 10% of yielders.
So because the barrier to entry is only 5 years and the focus is heavily on that payout ratio, DGRO captures a really unique blend.
It does.
It holds the defensive stalwarts like Johnson & Johnson and ExxonMobil, but it also captures the tech giants like Apple and Microsoft that SCHD filters out. It sits right in the middle.
Which brings us back to FDVV. The fund that delivered the 18% return but cut its dividend.
The stealth tech fund.
Exactly. FDVV focuses heavily on high yield, but the catch is that it weights its holdings by market capitalization.
So the bigger the company, the bigger its slice of the pie.
Right. Ironically, this methodology allowed the Magnificent Seven stocks like Nvidia, Microsoft, and Apple to completely float to the top of what is ostensibly a dividend fund.
It effectively became a tech fund.
Pretty much.
And tech companies notoriously don't prioritize dividends. They prioritize aggressive growth and share buybacks. So the mystery of FDVV's dividend cut is solved. Now, this is where the strategy really comes together for you listening. A common instinct when looking at these 4 funds is to think, hey, I'll just buy equal weights of all 4 to be safe and diversify.
But if you do that, you're falling into a massive overlap trap.
Talk to me about the overlap trap.
You have to look at what the algorithms are actually buying underneath the ticker. If you buy VIG and DGRO together, you're largely buying the exact same stocks.
Really? How much overlap?
They share a massive 67% overlap by weight.
67%.
Yeah. You aren't diversifying. You're just paying 2 different expense ratios for the same portfolio.
That's a huge blind spot for a lot of investors. They think more tickers automatically means more diversification.
It doesn't.
But what's the alternative?
Look at DGRO and SCHD. If you pair those two, you only have an 18% weight overlap.
Oh, wow. That's practically nothing.
Right. They hold entirely different kinds of companies. DGRO gives you the tech exposure and the dividend growth, while SCHD gives you the high starting yield, the energy sector, and the defensive staples.
So together, they form a highly complementary pairing without redundant overlap.
Precisely.
Okay, so we've mapped out the DNA and seen how these filters operate in the real world. Let's shift gears. Let's look at the 10-year projection.
Let's do the math.
We need to see how this actually plays out over time for you, the listener. Let's set up a quantitative scenario. Assume you take a starting investment of $10,000 today.
Okay.
You turn DRIP on.
Meaning every single dividend is automatically reinvested to buy fractional shares.
Exactly. And to isolate the dividend mechanics, we'll assume a conservative, flat baseline of 7% annual share price appreciation across the board.
Using the 2026 data and historical averages, let's run the numbers on our two heavyweights, SCHD and DGRO.
Let's hear it.
SCHD starts with a massive advantage in current yield. Right now, it's sitting around 3.8% to nearly 4%.
That's a strong starting yield.
Combine that with its historical dividend key AGR of roughly 10.43%, and you have a very powerful compounding machine right out of the gate.
And DGRO starts with a much lower yield, roughly 2.02% to 2.23%.
Right.
But its historical dividend growth rate is 8.91%. with a 7.49% rate over the last 3 years. So DGRO is starting with less, but trying to grow it consistently.
Let's fast forward to year 10. This is where we see the magic of the compounding effect.
Okay, lay it on me.
Because DGRO's income stream compounds efficiently and it participates more in broader growth rallies, your yield on cost, meaning the dividend yield you're getting relative to your original 10 grand investment, climbs comfortably above 4.3% in year 10.
That's a solid yield on cost, but let's be totally transparent about the actual dollars hitting the account.
Yeah, let's talk cash.
Because SCHD's starting yield is almost double DGRO's right now, SCHD will generate significantly more actual cash flow in year 10.
Well,
even with DGRO's efficient compounding, it is mathematically incredibly difficult to bridge a 2% starting yield gap in just 10 years. If you need the cash to pay for groceries in 2036, SCHD prints more money, period.
that's true for the pure income generation. But if we expand our horizon, things shift.
Okay.
And we have the data for this. We looked at 20-year Monte Carlo simulations run by those retail quant communities.
Hard math, guys.
Right. And we aren't just looking at the cash the portfolio spits out. We're looking at the total net worth of the account.
Here's where it gets really interesting. In a 20-year run, DGRO actually has a higher overall net worth ceiling.
It does.
In a simulated 90th percentile bull market, the DGRO portfolio grew to $513,000 compared to SCHD's $478,000.
And we have to ask why that $35,000 difference exists.
It goes right back to the DNA we discussed earlier, doesn't it?
Yeah. Exactly. DGRO's algorithm allows it to capture more of the technology sector's upside. When the market rips higher over a 2-decade period, DGRO goes with it.
Driving the share price and your total net worth upward, even if the actual dividend cash flow lags slightly behind SCHD.
Yep.
But the Monte Carlo simulation didn't just test bull markets, right? It tests thousands of random market paths, including sideways markets and recessions. What happens in a lost decade scenario?
That's where SCHD really shines.
Oh, really?
In the lower percentile outcomes, the simulations where the market trades flat or faces prolonged volatility, SCHD's high starting yield acts like a gravity well.
A gravelly well. I like that.
When share prices are suppressed, those DRIP reinvestments are buying up cheap shares at a rapid pace using that 4% yield.
Right.
It acts as a massive shock absorber, compounding your share count aggressively while you wait for the market to recover.
It's the classic trade-off.
Yeah.
Do you want maximum total portfolio value in a bull run, or do you want maximum cash in hand and share accumulation during a flat market?
That is the big question.
Which brings us to the final verdict based on all this 2026 data. We've thrown a lot of percentages and methodologies out there.
A lot of numbers today.
Yeah. Let's synthesize this down into actionable intelligence for the specific goals you might have for your own portfolio.
Let's break it down category by category.
Yeah.
First category, best for total return.
Okay, who takes it?
The winners here are FDVV or DGRO. FDVV takes the crown if you firmly believe the mega cap tech rally is going to continue indefinitely.
Riding the Magnificent Seven.
Essentially, yes. But if you want a safer, long-term bet for balanced, high-ceiling total return without the risk of those frustrating dividend cuts, DGRO is the clear choice.
Second category, best for maximum current income. The winner, hands down, is SCHD.
Absolutely.
With a yield nearing 4% and a strict fundamental bouncer at the door ensuring those dividends are backed by real cash flow, it's the perfect fund for locking in a reliable cash flow lifestyle right now.
If you're retiring tomorrow and need to replace a paycheck, SCHD is built for that.
Definitely.
Finally, the third category, best for downside protection. This is actually a tie between SCHD and DGRO.
A tie?
Yeah, but they achieve it in different ways. SCHD has a famously low beta of 0.71.
Okay, without getting too deep into the weeds, that metric just means it's significantly less volatile than the S&P 500, right?
Right. It barely blinks when the broader market throws a temper tantrum. In the last 5 years, its maximum drawdown was only negative 16.86% compared to VIG's negative 20.39%.
And DGRO earns its tie here because of that brilliant 75% payout ratio cap we talked about.
Exactly.
That cap acts as a structural hedge. It guarantees that the companies inside DGRO are earning substantially more than they're paying out.
Yeah, when a recession hits and corporate profits dip, DGRO's companies have a massive 25% financial cushion to maintain their dividends.
They survive the correction smoothly without slashing payouts.
You're protected by strict balance sheet valuation with SCHD, and you're protected by payout buffers with DGRO.
So, what does this all mean? It means that finding the best ETF isn't about pulling up a 5-year chart and blindly buying the one with the highest past return.
Never is.
It's about matching the fund's DNA to your current life stage. Ask yourself, are you in the accumulation phase of wealth? Are you trying to aggressively grow your net worth over the next 10 or 20 years with DRIP turned on?
If so, DGRO or VIG heavily align with your goals.
Or are you transitioning into retirement, needing to live off the cash flow right now without selling your underlying shares? If that's the case, SCHD is your workhorse.
And if we connect this to the bigger picture, there's a macro-level risk we haven't touched on yet, but it's crucial for the next decade. Think about the shifting landscape of tax codes.
Oh, that's an interesting angle. Where are you going with this?
Well, consider the pressure on global deficits right now. If capital gains or dividend tax structures change dramatically in the late 2020s, penalizing cash payouts to investors, how will corporations respond?
Oh, wow.
We could see a massive shift where even traditional dividend-paying companies abandon their payouts in favor of aggressive, tax-efficient share buybacks.
Wow. If the golden age of dividends shifts entirely toward a buyback model, funds with rigid dividend growth rules like VIG or SCHD could suddenly find themselves filtering out the best companies in the world simply because those companies changed how they return capital to shareholders.
Exactly.
It forces you to wonder if the traditional dividend strategy itself might face an existential threat from the tax code.
You have to constantly question the algorithms running your money. Do the rules of your ETF still make sense for the economy we're heading into, or are they built for the economy we just left?
That is a massive question to leave you with. It's all about knowing what you own and why you own it. We hope this deep dive into the quantitative data has given you the tools to look at your own financial war room with a bit more clarity.
Thanks for listening.
Thank you for joining us as we unpack the numbers, the DNA, and the projections for these funds. Keep questioning the data behind your dollars, and we'll see you on the next deep dive.